Friends, thank you for being here today. For decades, New Zealand held a uniquely coveted position in the global imagination. It was a nation brandished as a model for the developed world, a remote paradise defined by breathtaking landscapes, remarkable political stability, and a quality of life that was the envy of millions. Economists captivated by its robust growth that outpaced many of its developed peers bestowed upon it the title of a rock star economy. It was a country that seemed to have solved the complex puzzles of modern nationhood, balancing prosperity with well-being and progress with nature. With a relatively small population of just over 5.3 million people, it cultivated an image of a society that enjoyed a high standard of living, excellent education, stable governance, accessible health care, and a refreshingly egalitarian culture. This was the brochure, the promise of a clean, green, and open nation thriving at the edge of the world. Today, however, that same country is confronting its most severe economic downturn since 1991. The rock star's performance has faltered, and the applause has been replaced by a growing chorus of concern. What if I told you that this idyllic nation is now experiencing an exodus of its citizens on a scale that rivals some conflict zones? And what if the very foundations of its prosperity, its pristine land, and its comfortable lifestyle were masking deep structural fractures that now threaten to break the country's economic future? A record-breaking exodus of its own citizens is underway as Kiwis leave their homeland in numbers never before seen. National productivity, the very engine of sustainable prosperity, is not just stagnating, but actively falling. Meanwhile, the cost of essentials from housing to basic groceries has spiraled out of reach for a significant portion of the population, fracturing the nation's long-held social contract. The paradise, it seems, has fallen from grace. The question that echoes from the rolling hills of the Waikato to the bustling streets of Auckland is no longer one of admiration, but of alarm. How did this idyllic nation find itself on the brink? This analysis will uncover the deep-seated structural weaknesses, policy missteps, and demographic pressures that are converging to challenge New Zealand's future, threatening to turn its celebrated stability into a cautionary tale of squandered potential. So, to get to the core of the issue, we have to talk about something deeply troubling that's happening right now: a mass immigration that's draining the country of its best and brightest. This is not the gentle trickle of young adventurers seeking a year of overseas experience, but a flood of mass immigration that is draining the country of its most valuable asset. In the year 2024 alone, a staggering 128,700 people left the country, marking the largest annual departure ever recorded. To put this in perspective, New Zealand, a high-income, stable democracy, is experiencing a rate of immigration that rivals on a per capita basis that of some third-world countries embroiled in active conflict. The scale of this exodus is a five-alarm fire for policymakers, signaling a profound loss of faith in the nation's future by those who know it best. The most damning statistic reveals the true depth of the issue. Over 10% of the entire New Zealand-born population, approximately 600,000 people, currently resides in Australia. This is not merely a demographic shift. It is a hollowing out of the nation itself. The profile of those departing has also undergone a concerning transformation. Historically, Kiwis who left were predominantly young people on a rite of passage, many of whom eventually returned with new skills and experiences. Today, the departures are increasingly comprised of mid-career professionals and their families, as well as retirees groups that have historically formed the stable bedrock of the local economy and community. These are not transient adventurers. They are established citizens, often homeowners and taxpayers, who are making a permanent decision to uproot their lives, shifting their center of gravity, their community ties, and their economic contributions overseas. The likelihood of their return is slim. This mass departure has been aptly termed a national brain drain, as the exodus is disproportionately made up of the very individuals New Zealand needs to build a more resilient and innovative economy. Engineers, scientists, information technology professionals, healthcare specialists, and entrepreneurs are leaving in droves. When they depart, they take with them years of state-subsidized education, invaluable professional experience, and most critically, the potential to found the next globally competitive company or design the next breakthrough product. A country cannot innovate when its innovators are leaving. This loss of human capital creates a vicious cycle. The departure of skilled workers weakens the economy, which in turn reduces opportunities and incentivizes even more skilled workers to leave. The consequences of this trend are becoming painfully visible, particularly in the nation's small towns and provincial areas. Sociologists and demographers warn of a hollowing out effect, where the departure of working-age adults erodes the fundamental social and economic fabric of communities in towns that were once thriving hubs of industry. The closure of a local mill or factory is now often followed by a wave of residents heading overseas. The results are shuttered storefronts on main streets, falling enrollments in local schools, and immense pressure on public services. Once a school's roll drops below a certain threshold, teacher, layoffs become inevitable. Once the local general practitioner retires, finding a replacement becomes a near impossible task. This is not a distant abstract economic theory. It is the lived reality of a nation slowly bleeding its vitality. This process also creates a damaging demographic feedback loop. When mid-career families leave, they take their children with them, shrinking the pipeline of future workers and taxpayers. When retirees relocate, often to be closer to their adult children who have already moved, they take their savings, spending power, and community involvement with them. The result is a slow motion drain of both human and financial capital, leaving behind an older, less dynamic population to shoulder a growing economic burden. To truly understand this exodus, you have to ask a simple question. Where are all these people going? The answer, overwhelmingly, is Australia. And the relationship between the two nations is the central mechanism driving this demographic shift. It is a common assumption that Kiwis are fleeing New Zealand's notoriously expensive housing market. However, this narrative is an oversimplification. While housing affordability is a severe problem, more than half of those leaving are moving from the frying pan of New Zealand's property market into the fire of Australia's, where major cities are often even less affordable. The decision to leave, therefore, is not primarily about finding cheaper homes. It is about the pursuit of something more fundamental: opportunity. The pull of Australia is multifaceted and powerful. First and foremost are wages. For similar work, pay in Australia is on average a staggering 26% higher. In certain high-demand industries, that wage gap can stretch to an astonishing 200%. This is not a minor incentive. It is the difference between treading water financially and actively building wealth, between struggling to meet mortgage payments and securing a comfortable future. Beyond salaries, the career prospects are simply broader and deeper. Australia's larger, more diversified economy offers a greater number of opportunities for specialized high-end professions. For a fine arts curator, a high-level corporate manager, or a cutting-edge scientific researcher, the simple reality is that most of the jobs in their fields are in Sydney or Melbourne, not in smaller New Zealand cities. There simply is not enough demand in New Zealand's smaller commercial centres to support these roles at scale. Furthermore, educational opportunities are more plentiful. Australia is home to a larger number of world-class universities, and critically, it treats students from New Zealand as domestic students when it comes to tuition costs. Certain Kiwis who meet residency requirements are even eligible for Australian government-operated student loans. Anecdotal evidence such as medical schools, where nearly half the student body hails from New Zealand, highlights the extent to which Australia's educational infrastructure is absorbing New Zealand's future talent before their careers have even begun. The mechanism that makes this mass migration possible is the uniquely seamless relationship between the two countries, codified in the Trans-Tasman Travel Arrangement. This agreement functions much like the freedom of movement within the European Union, allowing citizens of either nation to live, work, and purchase property in the other, with very few restrictions. This legal framework is augmented by a shared language and an extremely close cultural affinity, making the transition far less daunting than a typical international move. A New Zealander moving to Australia faces minimal culture shock and is less likely to encounter the social friction that migrants from other parts of the world might face. This dynamic has created a significant demographic mismatch that works to New Zealand's detriment. While it loses nearly 600,000 of its predominantly young, skilled, and productive workers to Australia, it gains only about 90,000 Australians in return. Crucially, the Australians who move to New Zealand tend to be older, independently wealthy retirees drawn to the country's scenic beauty. They are seeking holiday homes in Queenstown or quiet retirement lifestyles, not contributing to the labor market or tax base in their peak earning years. This has given rise to another worrying trend. New Zealand is increasingly being used as a backdoor into Australia. To combat its brain drain, New Zealand has had to rely on immigration, primarily from large population centers in Asia, to fill critical workforce gaps. However, because it is generally easier to obtain working visas, permanent residency, and ultimately citizenship in New Zealand, many new migrants see it as a stepping stone. Once they have secured a New Zealand passport, they too can take advantage of the Trans-Tasman Arrangement and move to Australia. These first-generation citizens are naturally less attached to a country where they have only lived for a few years, making them even more likely to pursue the greater economic opportunities next door. In essence, New Zealand is expending resources to attract and settle migrants, only to lose a significant portion of them to its larger neighbor. Reversing this trend is extraordinarily difficult. Any attempt to tighten the open relationship with Australia would face immense political opposition. With over 10% of New Zealand's voting population living in Australia, they form a powerful bloc that would resist any policy making their lives harder. Geopolitically disrupting what is arguably one of the friendliest international relationships in the world would be unthinkable economically. There is also an argument that the system, while damaging, is not entirely one-sided. Many Kiwis who work in Australia eventually return later in their careers, bringing back valuable skills, experience, and significant capital that gets injected back into the local economy. However, the net effect remains a catastrophic drain of talent during its most productive years. But this immigration crisis is really just a symptom of deeper, long-standing problems within the economy. The first major structural weakness we need to talk about is the country's surprisingly narrow and low-value economic base. The nation's small population and extreme remoteness create significant hurdles to building globally competitive industries. Almost any scalable industry, from advanced manufacturing to financial services, can be done more cheaply at a larger scale and much closer to major global shipping lanes in Asia or other economic hubs. Even within its own region, New Zealand is overshadowed. Why would an international firm choose to do its banking in Auckland when Singapore is closer, more integrated into the global financial system, and serves as a gateway to Asia? Even for regional operations, Sydney offers a more widely recognized currency and a much larger market. As a result, the industries that thrive in New Zealand are largely those that must be there: domestic services, tourism, and most prominently, agriculture. This has led to an economy with a surprisingly narrow base heavily dependent on the export of a handful of primary products. Approximately 60% of all of New Zealand's goods exports come from just a few key commodities, often with minimal processing before they are shipped abroad. The giant in this portfolio is dairy. Every year, dairy exports bring in around 18 billion New Zealand dollars, accounting for roughly a quarter of all goods exports. It is followed by meat, primarily beef and lamb, worth about $8.4 billion or 12% of goods exports. Forestry contributes another $5 billion annually. However, herein lies a critical problem of value. A majority of New Zealand's forestry exports consist of raw logs. These logs are loaded onto ships, sent overseas to countries like China, and processed into high-value goods like furniture, flooring, and building materials. New Zealand effectively outsources the most profitable part of the value chain, the processing, manufacturing, and design work, along with the higher fee-paying jobs that come with it. This is a recurring theme across its primary sectors. The country functions like a resource-rich mine that sells its raw ore without refining it. Someone else gets the biggest payday. This economic model, heavily concentrated in primary commodities, carries three significant risks. The first is market exposure. The heavy reliance on a few products makes the economy acutely vulnerable to fluctuations in global commodity prices and demand from key markets. For instance, 26% of all dairy exports go to China. This means a quarter of New Zealand's single largest export pillar is dependent on the economic and political climate of a single trading partner. A slowdown in Chinese demand, a trade dispute, or geopolitical tensions could decimate New Zealand's export earnings overnight. The second risk is environmental limits. The land, water, and soil can only sustain so much intensive extraction before productivity declines or environmental regulations tighten. The dairy industry, for example, faces increasing scrutiny over its water usage and its contribution to nitrate pollution in the country's rivers and lakes. These environmental pressures represent a hard ceiling on future growth in the nation's most important sector. The third risk is climate volatility. Shifting weather patterns pose a direct threat to an economy built on agriculture, forestry, and fisheries. More frequent and intense droughts can slash milk production. Warmer seas can disrupt fish stocks, and severe storms can devastate orchards and forests. In an era of increasing climate instability, relying on a few unprocessed natural exports is like balancing the entire national economy on a very small and precarious platform. The lack of a strong, diversified industrial base means the country has few economic shock absorbers. When commodity prices fall or a drought hits, there are no other major sectors to pick up the slack, making economic downturns deeper and recovery slower. But the economy's problems don't stop with exports. To see the next layer, we have to look at something that has become a corrosive national obsession: housing. For decades, property has transcended its function as shelter to become the country's primary investment vehicle, the default destination for capital, and the central pillar of the national economy. The numbers are revealing. Real estate services alone account for around 11% of GDP, and when construction is added, that figure rises by another 5 to 6%. This means that a huge slice of the economy, somewhere between 17% and by some broader estimates as high as 50%, revolves around the non-productive activities of buying, selling, building, and financing houses. This fixation has created a dangerous wealth illusion. On paper, many homeowners feel richer as the value of their properties has skyrocketed. Over the past decade, house prices rose by an astonishing 130%. However, this wealth is tied up in illiquid, non-productive assets. It is not invested in businesses that generate exports, drive innovation, or create high-paying jobs. Instead, it sits passively in bricks and mortar. The core problem is not just that prices rose, but how catastrophically they have disconnected from incomes. The median house in New Zealand now costs 8.88 times the median household income. For context, the OECD considers a multiple of around 3 times to be the benchmark for affordable housing. New Zealand's ratio is nearly triple that level, making it one of the most unaffordable property markets in the developed world. This crisis in affordability has profound social and economic consequences. Younger generations are effectively locked out of home ownership, a cornerstone of wealth creation, or are forced to take on massive life-altering levels of debt. Meanwhile, older generations, sitting on significant untaxed capital gains from their properties, have little incentive to invest in riskier, more productive ventures. Why risk money on a new business when the value of your house continues to climb effortlessly? This dynamic results in a massive misallocation of national capital, starving the innovative sectors the country desperately needs to grow. Now, this illusion of wealth is threatening to turn into a very real crisis. New Zealand is facing a mortgage reset cliff. About 40% of all home loans were taken out between 2020 and 2021, when interest rates were at historic lows of under 3%. Many of these fixed-rate loans are now rolling over to new rates of 6% or higher. For many households, this means their monthly mortgage repayments could double almost overnight. For families already stretched thin by the rising cost of living, this is not just a budgeting challenge. It is a potential catastrophe. Higher repayments will inevitably lead to a sharp contraction in consumer spending, slowing the entire economy. A rise in mortgage defaults and forced sales could push house prices down, wiping out the paper wealth of those who believed property was a one-way bet. A nation cannot build a sustainable future on houses alone. And when you dig even deeper, you find that all of these issues are rooted in New Zealand's most fundamental economic problem, a chronic and severe lack of productivity and innovation. For a developed nation to increase its standard of living, its workers must become more productive. That is, they must be able to produce more value per hour of work. This is the only sustainable way for wages to rise without causing inflation. In New Zealand, productivity growth has ground to a virtual halt. A key driver of this stagnation is a severe and persistent underinvestment in its own future. New Zealand spends just 4% of its GDP on research and development R&D. The OECD average is 2.7%. This means New Zealand is investing at a rate of nearly half that of its peers. This is not just an accounting difference. It is a strategic failure, with compounding consequences. While other developed nations are pouring resources into new technologies, medical breakthroughs, and advanced manufacturing, New Zealand is falling further and further behind. Low R&D spending means fewer high-value industries emerge. Innovative startups have a harder time growing. Universities struggle to commercialize their research, and existing companies lose their competitive edge. This innovation deficit isn't just an abstract economic statistic. It is a cultural and structural problem that directly shapes the opportunities available to its citizens. Part of the challenge lies in the very nature of the country's business landscape, which is overwhelmingly dominated by small and medium-sized enterprises. While these memes are the backbone of local communities, they often lack the scale, capital, and global reach necessary for significant long-term R&D investment. Unlike economies that are home to large R&D-intensive multinational corporations that can pour billions into research, New Zealand's corporate ecosystem is smaller and more fragmented. This creates a chicken and egg problem. Without large innovative companies, there is little private sector demand for high-level research, and without that research, it's difficult for large innovative companies to emerge. This is compounded by a relatively underdeveloped venture capital market, making it exceedingly difficult for promising startups with groundbreaking ideas to secure the funding they need to scale up and compete globally. Too often, a brilliant Kiwi entrepreneur with a world-changing idea must move to Silicon Valley or London to find the investment and ecosystem needed to turn that vision into a reality. This dynamic creates a tangible career ceiling for the country's most ambitious and highly skilled professionals. A talented software engineer, a brilliant biotech researcher, or a forward-thinking product designer will inevitably reach a point in their career where the next logical step, the most challenging projects, the highest salaries, the greatest opportunities for global impact, simply does not exist within New Zealand. The decision to move to Sydney, London, or New York becomes less of a choice and more of a professional necessity for anyone wanting to operate at the top of their field. This is not a reflection of a lack of talent within New Zealand, but a direct consequence of an economic structure that fails to create a compelling reason for that talent to stay. The brain drain, therefore, is not an isolated problem, but the final logical outcome of this innovation failure. The country is effectively educating its best and brightest only to watch them leave to generate wealth and innovation for other nations. This failure to build a powerful third engine of growth beyond commodities and housing reinforces the country's dependencies, trapping it in a low-growth cycle where the easiest way to make money is not by inventing the future, but by selling off the country's natural resources or speculating on its land. The results of this underinvestment are laid bare in the productivity numbers. From 2012 to 2022, labor productivity in New Zealand grew by a dismal 0.3% per year. Across the OECD during the same period, the average growth rate was 1.5%, 5 times higher. This productivity gap is the core reason why incomes have stagnated while costs have continued to climb. The economy simply isn't generating enough new value to support a higher standard of living. Another measure that captures this weakness is the Economic Complexity Index, a global ranking that measures how sophisticated and diverse a country's exports are. In 2023, New Zealand ranked 50th in the world. This low ranking confirms that the country exports simpler, less processed goods compared to its peers. As discussed, this leaves the economy dangerously exposed to commodity price swings. Countries higher up the ranking like Switzerland or Japan have numerous advanced industries. If one sector slows down, others can pick up the slack. New Zealand does not have this luxury. All of these forces, low R&D investment, weak productivity growth, a lack of economic complexity, and the resulting shortage of high-paying jobs feed into each other, creating a vicious cycle that culminates in the brain drain. The very people who could help reverse these trends, the scientists, engineers, and entrepreneurs, are leaving for better opportunities elsewhere. For years, New Zealand was able to mask these deep structural weaknesses with property booms and high commodity prices. But as those props begin to wobble, the profound lack of an innovative, productive core is being exposed as the primary reason why the country risks going broke. As if these deep-seated, structural problems weren't enough, they've been dangerously amplified in recent years by a series of jarring policy missteps and looming fiscal time bombs. The government's response to the COVID-19 pandemic, while successful in preventing an immediate economic collapse, set off a chain reaction that has destabilized the economy. Massive fiscal stimulus and record low interest rates poured fuel on an already overheating housing market and drove consumer demand far beyond what the economy could supply, triggering a surge in inflation. The very policies meant to protect the economy had supercharged one of its most unstable foundations, the speculative property bubble. Then came the overcorrection. The Reserve Bank of New Zealand embarked on a series of record interest rate hikes, one of the most aggressive tightening cycles in the developed world. The central bank openly stated that its goal was to engineer a recession to bring inflation under control. This was followed by conflicting signals from the government, which, while the private sector was reeling under higher interest rates, began to cut public spending and slash thousands of public sector jobs. This policy whiplash, first overheating the economy, then aggressively cooling it while simultaneously cutting government demand, destabilized both households and businesses. Compounding these errors, policymakers were often decision-making in the dark, relying on flawed and delayed economic data that was later revised, eroding confidence in the country's economic management. By the end of 2024, the outcome was clear. HSBC ranked New Zealand as the worst-performing developed economy in the world.